In this video, we're going to talk about Mullen Automotive, trading under the ticker symbol MULN. At the moment, the financial market is very volatile, and we have to be careful about which stocks to buy, as well as the exposure and the timing of our trades. This video is going to cover the recent price actions and the technical aspects of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events. If they're significant, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock decreased to 75 cents before closing the trading day at around 76 cents. We should pay attention to the 55 cents nearby because it was tested multiple times as a solid support, making it a significant level to watch out for. Over the past 30 days, the trend of the stock has been bullish, but considering the trade and the fact that the volatility may play for or against it, and the recent price actions suggesting that the market is itching towards higher places, the volume does need to be larger than what it is right now to actually pull it off. From the perspective of a longer time frame, 6 months and above, the trend of the stock has been ranging between penny stock level and around $16. In the long term, the stock would need to prove to the market that it can make actual products, and in a recent report, they have given some actual hope to the investors, because their battery technology is showing a lot of potentials. This can be used as both an asset to boost the company's revenue in future, and also increase the company's value in a merger and acquisition scenario. When we look at the price trend overall, Mullen will show to the market that it wants to bounce back from a very low point for the company and for the industry. The question is whether the shareholders will now act on this desire, and if the capital is willing to make a comeback in a sector where, historically speaking, capital has been coming in and out in huge quantity and in relatively short period of time. The trading volume of Mullen Automotive has recently been 157 million shares versus an average volume of 102 million shares. Over the previous 52-week period, its price fluctuated between 52 cents and $15.90. The market cap of Mullen Automotive is currently at $27 million versus the enterprise value at around $113 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes financial statements, so it's less reactive than the market cap and often more lenient for many other companies. One key element to note regarding the enterprise value is that for growth-type companies, the most significant assets they often own is called goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or grow faster, partially because it may have a better management, stronger brand recognition, a bigger online following, and so on. It is what makes a company unique versus its competitors. So it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and because it's also less reactive to the market cap in very volatile situations. If the company goes to liquidation, the goodwill would be completely gone, and we would be left with potentially less assets to distribute amongst shareholders and debt holders than what we see on the balance sheet right now. When we compare the current price to its historical price fluctuations, the stock is 51% higher than the 1-month low, 51% higher than the 3-month low, and 51% higher than the 52-week low. On the options market, which gives a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 358% versus the historical volatility at 336%. The put-call volume ratio is currently at 0.16. It is normal for most stocks to also tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 26,000 contracts a day versus the 30-day average of 13,000. Regarding the open interest, the most recent volume of open interest is 113,000 contracts versus the 30-day average of 21,000 contracts. Regarding the shareholder structure, institutional shareholders own 4% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. It's relevant to understand the shareholder composition of a company because this can help us to determine if we should hold the stock long-term or to simply view it as a trade opportunity. If the stock is mainly held by retail traders, then this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Usually the consensus is that there should be about 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, a lot of exceptions would apply because many good companies are also mostly held by retail traders. But this, so far, is the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes, when there are significant short interest in the total volume, it can be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 6% of the total float, and 42% of the transactions are coming out of the dark pools. Overall, my opinion on Mullen Automotive is bullish, mainly because the stock is trading so low compared to its historical levels that it would be safer to buy in now, compared to if it were around $6 to $8. The maximum exposure I would recommend is 1 to 3% of your portfolio. So for the immediate term, my recommendation is to enter in the stock, considering the recent price action and the promising price levels that are very close to where the stock is right now. I would recommend to separate your allocation in batches of 25% at a time so that you can have enough room for later purchases. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But It's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock, and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity